Okay, so you start your own business and you love it. It's great. You've got a good product or service you provide, and you've got an even greater customer base. And you even look to expand and becoming the next big Woolworths. And it's all thanks to the great Jonathan Tyler's Accounting 2 Financial. But one of your employees has told you that they paid out of pocket for postage stamps for the company, and you're not quite sure what to do. So Tyler comes to you in your dreams, and he tells you to set up a petty cash fund. And so you do. Petty cash fund. A petty cash fund is an allocated amount of cash kept on hand to pay for minor expenditures. This amount will vary across companies, but its operation will always involve the same three activities: establishing the fund, making payments from the fund, and replenishing the fund. Let's start with establishing the petty cash fund. Firstly, a petty cash fund is established by writing a check for a desired amount for the fund and then transferring that said amount into a petty cash fund account to be looked after by an employee, otherwise called a custodian. A journal entry would then be made to record the establishment of this fund. For example, if a company put in $100 toward establishing a petty cash fund, it would look like this. After the fund is established, you're going to have to make payments from the fund. This should be used to pay for minor expenditures, and these payments are made either by A. Cash is taken from the fund to make a payment. So for example, if the custodian uses the petty cash fund to pay for stationery, postage or supplies. Or B. Employees seek reimbursement from the funds for payments that they have personally made toward the company. In either scenario, the custodian overlooking the petty cash fund should collect receipts for any and all uses of the petty cash fund for recording purposes. It is important to note that individual payments are not to be recorded during this process, but rather when the fund is replenished. Lastly, the final function of the petty cash fund is replenishing the fund. So as the fund decreases, the fund must also be replenished. The business must record all of its accrued expenses using the receipts noted in making payments from the fund, and finally the company must write and cash out a single check for the amount that brings the fund back to its original balance. So what if the amount needed to replenish the petty cash fund does not equal the total amount of received expenses? So in this hypothetical scenario, the cash requested to replenish the fund is $87, but the total amount of receipts is $85. So this may occur when the custodian does not obtain all receipts or has been given an incorrect amount of change. Thus, this results in a discrepancy within the petty cash fund, and these amounts must be recorded in a temporary account called cash over and short. So if a business is cash short, the account would be put into a debit balance, which increases expenses. And vice versa, if a business is cash over, the account would be put into a credit balance, which decreases expenses. So using that last example, the company is cash short, and a total of $2 would be needed to balance out these accounts. A general quick rule of thumb is to put the cash over and short entry on the side that is smaller, in order to make it equal the larger account balance so it balances out. Thank you so much for watching, and I hope this screencast helped contribute to your understanding of the petty cash fund and its use and purpose in a business. Thank you.